80C, Public Provident Fund, NPS, equity-linked savings schemes, income tax. These words are those that literally scare most of us. There are many of us out there who not only want to save our tax, but we also want to try and understand what is it that our accountants are saying. So how can we use it to our advantage? Keep watching till the end. Let us first talk about the all-famous section 80C. What is this 80C and how can I use it to my advantage? LIC premiums, ELS, which is equity-linked savings schemes, and ULIPs are some of the schemes that investors can claim an exemption under section 80C of the Income Tax Act. But remember, if you choose the new tax regime, this will not apply and you will not get an 80C deduction. Wait a minute, so what does that mean now? The new tax regime will allow taxpayers who fall in the bracket of 5 lakhs to 7.5 lakhs to pay tax at 10% and not 20%. But they will forego their right to claim deductions. So you can either choose the 20% tax slab and claim all the deductions, or you can opt for the new 10% tax regime. By letting go of these tax exemptions, taxpayers who fall in the bracket of 7.5 lakhs to 10 lakhs could now choose the lower slab of 10% instead of 15%. In the same way, taxpayers in the bracket of 10 lakhs to 12.5 lakhs can opt for a lower tax rate of 20% rather than paying 30%, which would be under the old system. Now, let's explore these 80C instruments. The first instrument is called PPF, Public Provident Fund. This is known for its safety, high returns, and tax savings. PPF is one of the most popular long-term savings and investment products. To qualify for this year's exemption, one must have made the minimum contribution to the PPF account by 31st March. Next up is NPS, National Pension System. NPS has the advantage of allowing you to choose between equity and debt. Tier 1 and Tier 2 are the two types of accounts. For tax benefits under NPS, you must deposit a minimum of ₹1,000 every year into your Tier 1 account. Accounts will get deactivated if these contributions are not made. Equity-linked savings schemes. These are my favorite. This is a mutual fund that invests a large portion of your assets in equity-linked securities. Since ELSS is the only mutual fund scheme that is eligible for tax deductions under Section 80C, it is also called a tax saver fund. So these were the instruments that a regular person can invest in to claim tax deductions under Section 80C of the Income Tax Act. Remember, you have to go with the old income tax regime to get all these deductions. Or you could save yourself the hassle and just choose the new income tax regime. The choice is yours. I hope you share your thoughts with us and keep watching for more videos.